and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global, and we're coming to you today from the inaugural TFG Geneva conference in Switzerland. I'm joined by Aaron Bailey of Marsh, and we're going to talk about one of the topics that I've been finding the most interesting over the day, commodities and insurance in emerging markets. Aaron, welcome to Trade Finance Talks.
Thank you for having me.
And please, could you just introduce yourself, tell me about your role within Marsh, and what brings you to TFG Geneva this year?
Yes, so Aaron Bailey, I lead our global energy and commodities group for Marsh Credit Specialties. What does that mean? Effectively, we try to facilitate trade and investment across global commodity markets using a combination of non-payment insurance, political risk insurance, and surety bonds and guarantees. Ultimately, we're trying to support continued trade in spite of geopolitical risk and economic volatility. What brings me here today is really just getting insight from our clients, insurer partners, and just having an ear to the ground in terms of what's happening in the global markets so that we're more informed and can make better strategic decisions for our clients.
Great, hopefully it's been a productive one for you then.
Absolutely, yeah.
So all year we've been hearing about how global supply chains are reconfiguring and emerging markets are being brought to the fore, but as we were talking about in our panel session earlier, in the commodities sector, emerging markets are no new thing. So could you tell me a little bit about the credit risk dynamics within emerging markets?
Yeah, I think so the credit insurance market has really built itself out of the emerging market because it's underpinned commodity trade finance and investment into the region. So commodity houses wouldn't be where they are today without the emerging markets, as upstream materials are generally sourced in those regions, whether you're looking at agri in South America, if you're looking at oil and gas in West Africa, or you're looking at metals in the DRC. So we see the insurance market as a fundamental lever and support tool to facilitate such trade. And in terms of credit risk assessment, it's really a case of the depth of understanding that our clients have, the level of information and detail, and their experience in region. A lot of the traders and our clients and investors have been operating in region for 20, 30, 40 years. So they have people on the ground and they've worked through situations when they have gone awry or where there have been particular issues. So it's really a case of emphasizing their experience on the ground and helping infer any credit decisions that may come.
So what region specifically do you operate in?
Truly globally, we like to operate where our clients do. We have a broad base in terms of agricultural products, metals, oil and gas, across the energy space. So whether that's developed market or emerging market, we tend to either have people on the ground in situ, or we are operating in those countries or supporting trade to those countries. So it's really anywhere where our clients are, we are.
You talk about like decades of experience in these markets. Over that time, the global supply chain network has seen some pretty significant shocks. What has the impact been on emerging markets of these shocks, of the scale of like the COVID-19 pandemic, and what has insurance done for them? Yeah,
I think the impact's been minimal actually. The markets continue to support. We're still in a period where there's been minimal in the way of material losses to the market. And that's because the transactions that we look at and the clients we work with are sophisticated, they have long-standing experience, and they're logistics companies, so they're able to work around any issues as they emerge. And I think with the increase of tariffs, resource protectionism, we're seeing trade flows move and really alter depending on where you are and what asset class you work in. But trade continues to flow. The commodity world is fundamental to the global economy, and ultimately, as I said, they're logistics companies. As much as they are looking for making commercial returns and margin, they're able to move goods from one part of the world to another with minimal interruption. Thanks. And how have risk assessment tools evolved? Yeah, so within Marsh we developed our own, so we have tools to try and augment that process and help our clients. So for instance, we have World Risk Review that helps us look at a number of factors that determine the investment, country and counterparty risk in different geographies, which is really critical when you're looking at emerging markets and commodities. What type of factors does it consider? So it's the investment environment, the political environment and the credit environment. So it'll take a combination of those factors to determine a country risk rating, and that can be used to inform our own decisions and our broking in support of our clients' risks. Mm-hmm. And on the ESG domain, obviously things are changing quite quickly. We've had some scale backs, at least rhetorically, around the world.
How does insurance operate in emerging markets, supporting clients in ESG investments?
Yeah, I think it's a really good point, a good question to raise, because fundamentally a lot of the heavily polluting countries are in the developed world, and they're heavily reliant on hydrocarbons. It's a lot easier for the developed world to invest in renewables. And I think the key word, and we talked about this in the earlier session, the panel session, is all about transition. ESG is a transition, it's a process. So where the insurance market comes in is to proactively deploy their capacity to renewable projects, but also supporting traders, supporting investors as they continue to transition away. As long as they have active ESG strategies, that's a critical component. But if we look at China and their demand for LNG as a transition fuel versus coal, that is transition. Is it fully clean energy? No, but it's part of that process, and it's incumbent upon us to support them along that journey.
Do you think that there's been a danger of like a one-size-fits-all approach to ESG around insurance?
I think initially yes, and I think the recent volatility in the energy market or the global commodity market following Russia's invasion of Ukraine has shown that volatility, and it's shown where there's a reliance on flows in securing energy security in its broad sense, and that has driven an element of rollback on ESG, because ultimately we need to get power, we need energy for our economies. But that doesn't negate the importance of ESG. It's just, I think in the last couple of years, we've seen a focus on energy security as opposed to renewable energy and ESG friendly criteria.
That's good to know. And to close off, I want to ask you to look into the future a little bit. What partnerships or strategies do you think will be the most useful for insurance companies looking to support emerging markets and help them emerge further, I guess?
Well, I think it's really, and we talked about this again in the panel session, and it's a tripartite. It's a collaboration between insurers, financial institutions, traders, and the brokers. In the credit and political risk market, there's over 60 insurers now, where if you include the multilaterals. So it's a combination of how the capital markets, the unfunded capital market being the insurance market, can coordinate with one another, share experiences and insights to help facilitate trade and investment, and ultimately that will benefit both our clients and globally the economy.
Thanks a lot, Aaron. Yeah, partnerships have really been the word of the day here. Enjoy the rest of your time at TFG Geneva.
Thank you.